58% of total revenue. As a customer-focused organization, we maintain stringent multi-stage quality controls from raw material inspection to in-process checks and final microstructure and spectrometer analysis. Notably, we are one of only 2 recycling companies in India to have our lead ingots registered as a brand by London Metal Exchange, reflecting global quality recognition. Commodity price risk management and unique proposition. I would like to walk you through our approach to commodity price risk management and the hedging strategies that we employ to protect our financial performance. Our business is inherently linked to the movement of base metal prices on London Metal Exchange. To mitigate this volatility, we deploy a robust hedging mechanism covering both procurement of raw input and sales of finished products. For procurement, we typically take short positions in LME futures, while for finished products, we take corresponding long positions. These contracts generally align to a 90-day delivery cycle, enable us to lock in sale prices and protect margins. Our operational processes are engineered to extract the highest possible purity levels. The quality of our recycled products closely match that of products produced directly from ore. This enhances our product acceptance in global markets. Our branded lead products are LME recognized, offering global visibility and the ability to deliver directly to LME registered warehouses for seamless derivative settlements. This strategy ensures stable financial performance, real-time risk management, and strong resilience against fluctuations in global metal prices. Looking ahead, our strategic focus is on forward integration and new recycling domains underpinned by sustainability. We are planning to expand our horizon into copper cathode, copper wire rod, and copper bus bar manufacturing using finished products from our recycling facilities as feedstock, with electrolytic refining producing high-quality copper cathodes and wire rods. The project is being executed through our wholly-owned subsidiary Jain Technologies Private Limited. To support this, we have acquired a 6.58-acre land parcel in Sipcot Industrial Estate, Gumri-Pundi for this development. The total capex for phase 1 is estimated to be rupees 95 crores, which will be entirely funded through internal accruals, with rupees 45 crores already spent to date. As of September 2025, construction progress stands at around 70%, and the project continues to advance as planned. We expect operations to commence in Q1 of financial year 2027. The plant will have a capacity of 9,000 metric ton per annum, and all critical machinery has already been ordered, with deliveries expected to begin in the later half of Q3 financial year 26. Additionally, the facility will include an in-house rooftop solar power plant, enabling us to produce green copper cathode, further strengthening our commitment to sustainability and clean energy. Additionally, we have entered into a joint venture agreement with Texas-based CNY Group Investment Incorporation, part of the renowned CNY Global Group, one of the North America's largest exporters of non-ferrous metals, with an annual export volume of around 2.5 lakh tons and presence across 10 scrap yards in the United States. The JV will establish a 60 crore copper scrap recycling plant in Ahmedabad, focusing on recycling end-of-the-life materials such as cables, motors, alternators, starters. Jain Resource Recycling will hold a 55% stake and manage operations, while CNY Group, with a 45% stake, will source raw material scrap from the United States. This partnership marks another important step in our journey to build a global integrated recycling ecosystem in India. Our growth strategy emphasizes expanding recycling capacity and diversifying operations through new recycling verticals, including joint venture, international scrapyard acquisition, automotive tire recycling, e-waste processing, and solar panel recycling. With a diversified product portfolio, strong customer relationships, and strategic initiatives in forward integration and niche recycling, we are well positioned to capture emerging domestic and international opportunities. Coming to sustainability and ESG, I would like to touch upon a few important pillars of our business, which are sustainability and ESG principles. At Jain Resource Recycling, we continue to invest in advanced technologies and systems that help us optimize our recycling processes and minimize waste. Our focus remains on reducing our environmental footprint while creating a positive and lasting impact within the communities we serve. The reality is that as long as the human race exists, waste will continue to be generated in one form or the other. What truly matters is how responsibly we choose to deal with it. Someone must take ownership of converting this inevitable waste into a resource, and at Jain Resource Recycling, we have embraced that responsibility through sustainable, compliant, and future-ready recycling practices. We strictly comply with the environmental regulations, ensuring safe handling and disposal of hazardous materials through specialized third-party services. We also remain deeply committed to contributing to broader societal goal of promoting equity and long-term economic well-being through responsible recycling practices and inclusive growth. In alignment with India's evolving policy framework, the government has introduced mandates on the rate of recycled content for key non-ferrous metals, a policy development that strongly reinforces our business model and the importance of organized recycling. In copper, minimum recycled content has been mandated to be 5% from 2028, increasing to 10% in 2029, and further to 20% by 2021. Similarly, in aluminium, the mandated minimum recycled content is 5% starting from 2028, rising to 10% in 2029, and continuing to 2031. Additionally, under the extended producer responsibility regime, imports of non-ferrous metals, the domestic sourcing of non-ferrous metal will be eligible for EPR points starting from 1st April 2026, further incentivizing compliant recycling operations. Together, the EPR and RRT mandates are expected to accelerate formal recycling in India, improve material recovery rates, and open up significant growth opportunities for organized recyclers like us. In conclusion, our unwavering commitment to ESG principles, operational excellence, and innovation continues to drive our journey, ensuring sustainable value creation for all stakeholders while contributing positively to society and the environment. With that, I would like to conclude my remarks and hand over the proceeding to my colleague, Mr. Hemant Jain, Executive Director and CFO, who will take you through the detailed financial performance. Over to you, Hemant.
Sir, Hemant's line has dropped from the call. I am reconnecting him.
Hello.
Ladies and gentlemen, we have Hemant Jain connected with us. Hemant sir, please proceed.
Yeah. Thank you, Mayank sir, and sorry for this call got disconnected abruptly. So, good afternoon to everyone, and I'll quickly walk you through the key numbers, after which we'll open the floor for your questions. I'm pleased to share that our company has concluded the first half of FY26 with robust growth, delivering strong performance across the key business segments and financial metrics. We have reported a healthy growth in terms of revenue, EBITDA margin, and the PAT margin, underscoring the strength of our operations and the resilience of our business model. So now I'll come to the consolidated financial performance for the Q2 of financial year 26. The top revenue from the operation stood at around 2,114 crore compared to 1,392 crores in Q2 of FY25, which reflects a strong 52% growth on year-on-year basis, while the EBITDA stood at around 160 crores compared to 88 crores in Q2 of FY25, reflecting a strong 82% year-on-year growth, while the EBITDA margin stood at around 7.6%. Profit for the period stood at around 99 crores compared to 53 crores in Q2 of FY25, reflecting an 88% on year-on-year growth, while the PAT margin stood at around 4.7%. Now, I'll just give you the brief with respect to the consolidated financial performance of first half for the financial year 26, where the top revenue from operations stood at around 3,663 crores compared to 2,889 crores in H1 of FY25, reflecting a healthy 27% growth on year-on-year basis. The revenue from the repeat customer is around 88%, and the EBITDA stood at around 250 crores compared to 182 crores of H1 FY25, reflecting a strong performance of around 37% on year-on-year growth, while the EBITDA margin stood at around 6.8%. The profit for the period stood at around 155 crores compared to 112 crores in H1 financial year 25, which also reflects around 38% year-on-year growth, while the PAT margin stood at around 4.2%. Now, I'll take through you the segmental performance and the revenue mix for the first half of financial year 26, where the copper and copper alloy ingots contributes around 46% of the total revenue, and the lead products contribute around 48% of the total revenue, while the aluminum and aluminum products contribute around 4%, while the other segments contribute 2% of the total revenue. The first half of FY26 revenue mix between domestic and export markets stood at around 37% comes out of from domestic, and the 63% comes from the exports respectively. With that, I would like to conclude my remarks and hand over the proceedings to Mr. Jain, the Chairman and the Managing Director, who will share his closing thoughts before we open the floor for the questions. Over to you, Kamlesh sir.
Thank you, Hemant. To summarize, the first half of FY26 has been a milestone period for Jain Resources Recycling Limited, marked by our successful listing and strong operational performance and continued progress across all the business verticals. Our financial results clearly reflect the strength of our integrated recycling model, discipline, execution, and focus on value creation. We remain steadfast in our strategy of expanding capacities, deepening our presence across non-ferrous recycling segments, advancing our journey of forward integration into copper cathodes, wire rods, and busbar. Alongside, we continue to explore our new avenues such as acquiring strategic scrapyards, tire recycling, e-waste processing, and solar panel recycling, each aligned with our vision of building a circular and sustainable future. In this regard, during the quarter, we entered into a strategic joint venture with CNY Group Investments Incorporation, USA, established a copper scrap recycling plant in Ahmedabad. This partnership brings together JRR's operational expertise and CY's strong global sourcing capabilities, further strengthening our leadership in the non-ferrous recycling space and reinforcing our global integration strategies. Our emphasis on technology, compliance, and ESG principles continue to drive operational excellence and long-term competitiveness. As India advances towards greater formalization of the recycling sector through initiatives like Extended Producer Responsibility, EPR, and mandated recycling content norms, we believe the environment is increasingly favorable for organized and compliant players like us. With our diversified portfolio, strong customer relationship, and future-ready business model, we are confident of sustaining our growth momentum and delivering continuous value to all the stakeholders. With that, we'll be happy to take your questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Amit Lahoti from Emkay Global Financial Services Limited. Please go ahead.
Thanks for the opportunity and congratulations on the successful listing. So my first question is on operating performance for Q2, where we have 36% growth in revenue from the last quarter. So if you could quantify how much of it came from volumes growth, how much from prices, and if there is any inventory liquidation as well.
So partly I'll answer here that most of the sales are coming from volume growth. We have a hedging mechanism back to back, so the LME price goes up and down, doesn't much affect. But I still like Hemant to address the question. Hemant, can you reply this?
Yes. So with respect to can you repeat again the same question, please?
Yeah. So if you could quantify how much of the revenue growth of 36% sequentially came from volumes growth, how much from prices, and if there is any inventory liquidation.
Okay. So coming to one by one, with respect to the prices, as already Kamlesh sir has explained, we are completely hedged, and all the metals we work on a hedging mechanism. So there is no such volume growth from the price movement. Secondly, from the quantity perspective, as you can see, the lead performance has grown around 47%, while the copper has grown by around 14 to 15%. So this growth has come from that. And with respect to the inventory liquidation, we have actually the working capital cycle has gone up in this quarter as compared to the last year. So there is no such revenue coming up from the inventory liquidation.
Okay, and there's a big movement in working capital. If I look at all the key items, inventory, receivables, and payables, they've all gone up in this quarter. So any specific reason for this, or we expect this to unwind in the coming quarters, if that is the expectation?
Yeah, I agree. The working capital cycle has gone up from 38 days to around 52, majorly because of the high inventory days. And as you know, our major source of purchase is through imports. So globally, there are a lot of disturbance, like supply chain disturbance in the shipping line. Then there was an investigation of copper imports by US, which was done in Feb 2025. Because of that, the number of inventory days has gone up in this quarter. Even the debtors has increased, but we have tried to manage the same by, if you can see in my working capital cycle, where we have increased our creditors days also. And we expect this normalization starting from the end of December, and will again come back to the old level of inventory days, working capital cycle of around 40-42 days by the end of maybe in the middle of the last quarter of FY26, somewhere in the Feb of 2026.
Basically, Hemant is saying that the shipment of the materials come together. So the quarter one, there was a slow shipment from the US, but quarter two was a large shipment that started arriving from the US. And that's why the inflow of the material started in the bulk. But now it will get settled down and it will go normalize in the next few days.
Okay, and then my second question is if you could provide guidance for volumes and margins by segment. What is the sustainable level and what is the level that we are looking for, say, FY26 by segment?
Hemant, you would like to... actually, in this case, the segment is, I definitely expect copper to lead, and higher than any other commodity in our manufacturing business. And already the copper cathode plant and the wire rod plant is going to start from the next year, beginning of the next year, around February. So copper will lead the segment-wise and will grow faster than the other commodities.
Okay, but in terms of EBITDA per ton, for lead we have done 18,920 rupees per ton, and for copper we have done 51,000 rupees. So can we expect them to sustain, or is there going to be some variability in these numbers?
No, it will be copper. It will definitely sustain also, and the copper case, the EBITDA per ton will go up also because of the new plant. The new plant, what we are going to manufacture, copper cathode wire rod, basically value addition plant, and it is not adding top line, it is adding more a bottom line, and that's why EBITDA per ton in the copper will go up. I expect to go up in some next year.
Okay, thanks a lot.
I can't give that number, but I expect to go up.
Okay, thank you.
Thank you. We take the next question from the line of Vivek Gautam from GS Investment. Please go ahead.
Yeah, am I audible?
Yes.
Yeah. So congratulations on good set of numbers and good listing, sir. So basically, I just wanted to understand about this. We have been growing at the rate of 40% for the last few years. Are these growth rates sustainable, and what is the opportunity size for us in the future? And what are our differentiating factors versus competition? Is the sourcing capability is one of our differentiating factor or USP worldwide? And lastly, on CNY tie-up, which you have done, if you can highlight 2 points. Thank you.
So, as I said in the earlier interview also, that recycling is not a choice, it's a compulsion, and we have to recycle to live this life on this planet. So the recycling will keep growing, and there will be more and more recycling as human race exists in this world, as Mayank said earlier. This will keep coming, and India has unique strength and USPs in recycling. Compared to all the countries of the world, India is far, far ahead in recycling. That's why Indian companies will grow in recycling, as you have seen the performance of other companies also. So I don't think any problem will come, and what we are growing 40% CAGR in the last so many years, I expect the growth momentum to continue also, and as the data is last first half, you must have noticed that the growth is more than that. There is no problem. But CNY, yes, CNY is one of the largest exporter in USA from North America, and they have global sourcing capabilities, and they've been supplying to us also. And now they join us for putting a plant in near the Mundra port, which is where this venture is going to take place. And we expect next year the production to go online, and it will be a good addition in our copper revenue. And right now, I cannot disclose more than that, but I am sure that you will see the stunning results in next year.
Sir, our margins are slightly on the lower side versus competition. What could be the reason for that, and can we hope for the higher margin in time next few months?
Different companies have different models and different geography conditions. You cannot compare like apple to apple. If you compare apple to apple, then our peers, there are some peers are out of India and they have different models. And some peers, and since we are in copper recycling and we don't have any peers in copper, so our 70% sale is different from the peers. That circumstances we cannot be compared with the other peers, and our models and our margins are sustainable, long term, and it is going to definitely go up in the future because of the expansion and diversification and the value-added product what we are going to manufacture. So right now, what you're seeing, it will definitely sustain and will go up only.
And lastly, there was some news about the U.S. government and the recyclers in U.S., especially in aluminium, asking our U.S. government to place a ban on export of aluminium scrap. How big is the threat to us, and how big is U.S. as a sourcing destination for us for in different materials? And
so even I have read the article that. Even I also read the article, but basically U.S. do not have sufficient capacities to recycle so much of tonnage of aluminum which is generating in the US. We have to export. And second point is we are buying globally from 120 countries. So, like depending on US, of course, US is one of the major suppliers to us, but we buy globally, and I don't feel any threat for our raw material requirement. And aluminum is a very minor sale for us. So, an overall sale, the copper and lead is the main metals. And there are other markets for us to source the scrap and recycled material. So I don't think much said. And it's only just an initial talk, but US don't have that much of capabilities to recycle so much aluminum, and they have to export only.
No such restriction on copper and lead from US.
But then I would like to add here, so the proposal is to ban the export of UBC, although it is at a very primitive stage, but that is for used beverage can scrap, which we do not use. Our products do not use this scrap.
And no such restriction on copper and lead, sir?
Nothing.
US?
Nothing.
Okay.
Nothing. So far, nothing.
Thank you, sir.
Thank you. The next question comes from the line of Dheeraj Ram from B&K Securities. Please go ahead. Dheeraj, please unmute your line and proceed with your question. Since there is no response, we will move on to the next question, which is from the line of Naman Parmar from Nivshay Investments. Please go ahead.
Yeah, good afternoon, sir, and wish you a very warm and prosperous Happy Diwali and Happy New Year. So, firstly, on the lead side, I just wanted to understand, currently you have done around a 9.6% of margin, right? So, what is the percentage of the value-added products, and which value-added products are mostly going to other than the lead-acid battery requirements?
So we basically make only lead ingot in the lead segment, and we do not make any value-added product in the lead side. So our base finished goods is 99.97% lead ingots, which are base raw material for the battery manufacturers. And we also recycle the battery box and plastic granules, and we make the compound and we supply the plastic granules for the plastic box manufacturers. So that's what we do in lead, and there are not much value-added product in the lead side.
Okay, so then how we are able to make a very high margin on the lead side compared to the competitors, and how sustainable can we do this particular margin in the going forward?
There was earlier question, the other gentleman asked me that why such a low margin in the business, and now and good to hear that you are saying it's high margin. It's not a point of high margin or low margin. It's a point of the margins are, at par with the peers in the market, and this is for who are doing recycling in India. And I don't find these margins are sustainable. These are already rock bottom margins, and it's a scalable business. And the business of recycling, as when we more and more recycle, more and more we do production, the cost of production goes down because the variable expenses are also linked to the production. And that's why when the cost goes down, the margin should sustain. And we are expanding every year 30-40% capacities. In that circumstances, the margin will sustain, and the cost of the scale of production will benefit us in getting the better margin.
Okay. So has the industry is now, if you see on the battery side, the technology is shifting very fastly from lead to lithium and lithium to sodium. So what's your outlook for the lead in the future? Like, there will be a very good requirement for the lead recycling for next 2-3 years, or you see to come to any new technology for the recycling like lithium or anything else?
First of all, lead acid battery is not going to go anywhere. The lead acid battery will remain, will be used by all the cars, motorbike, or these other automobiles, because every lithium recycling, every lithium car company require a lead acid battery also to start the car, for headlights, and for the inside all the lights. They require only lead acid battery. Lithium batteries used only to replace the typical engine of the petrol and diesel. So it is not that lead acid battery is going to go anywhere. They will remain in the automobiles. They will not go anywhere. This is first. Second, for lithium recycling plant, we do have a strategy to in future, but right now the raw material is not sufficient enough to start a plant, and because the life of lithium recycling is very long, it's 8 years sometimes, and reuse more than recycle. So right now, because of scarcity of raw material, we are not planning, but we may plan in the future.
Okay, understood. Secondly, on the copper side, if we compare this with the other segment, it has currently a low margin, around 4.5 to 5%. But as you mentioned that as value-added products will kick in, you are expecting a very good margin. But if you can elaborate how maximum the margin can flow from step 1 to copper cathode to bus bar, so it will be very helpful. Yeah.
So we are going to value product of copper, and that's from the copper cathodes, and then we are making copper wire rods, and then we are making copper bus bar, and then we are going to do some trading. So every stage of this product will add at least 0.75 to 1.5% margin on different products with different application. I cannot give a exact number, but I of course expect EBITDA margin to go up by at least 3 to 4% in copper segment alone, and that will have the complete chain and will have the impact on EBITDA in a positive manner in a big way next year.
Means from 5 to maximum it can go to 8%, right? It's around the range.
So actually now what we are seeing is the overall margin of all the metals, including copper, lead, tin, plastic and all. Copper segment alone margin will be add up in this, but it will not impact lead and other metals. It will impact only copper.
Okay. And lastly, on the how maximum the capacity utilization you can reach and how you are expecting to utilize optimum utilization in next couple of years.
So right now we are utilizing more than 100%. Right now it is like utilization is very high. And we are doing very big because every year we always keep some grace capacity in our production planning. So we are right now utilizing more than 100%, and I don't think any problem will come for full capacity utilization in the months to come. And we are always expanding and to our present capacities also. So it will have this without any problem. I don't think any problem should come for capacity utilizations.
Okay. And any volume growth guidance?
Raman, I would request you to please join back.
Okay, yeah, I will join Thank you so much. Yeah.
Thank you. Ladies and gentlemen, in the interest of time and fairness to others, we request you to restrict to one question per participant. We take the next question from the line of Praful Kumar from Diamond Asia. Please go ahead.
Hi, sir. Many congratulations on very strong earnings. So broadly, two things I want to understand. In terms of sustainability, you have a significant edge in sourcing. So broadly, how the pipeline looks from the sourcing side for the next, say, 2 to 4 quarters? Is the Q2 performance more sustainable in terms of growth? And second would be on CAPEX. Post the IPO and the new projects you are working on, what kind of CAPEX and asset turn are you looking at in the business?
The first part I'll reply here. Our sourcing, we are increasing our sourcing country by country, and as we have told earlier also, we are 120 plus country now, and every year we add some countries and deep sourcing capabilities, and domestic sourcing also increases a lot now. And our domestic sourcing actually gone up very high in this current year, and because of the better compliance of GST, and the industry is very organized now. Can you put your mute actually? Okay. So can you put in mute yourself because a lot of disturbance. Yeah. So I was saying that our domestic sourcing has gone up very high, and I expect to go more and more domestic sourcing, and that's circumstances we don't have any shortage of raw material for next year. At least I'm very sure about that. Coming back to the point of the CAPEX, I would like Mr. Mayank Parekh to take this question.
So, on the CAPEX, one thing is about continuous expansion in the existing business. because as a strategy, whenever we exceed the capacity utilization above 80%, we add new capacities in the existing verticals so that we keep a healthy gap between the capacity installed and capacity utilized. On that account, we expect year-on-year capital expenditure of 20 to 30 crores per annum. Then we are working on the project of value-added products for copper, and the phase 1 consists of a plant with a capacity of 9,000 tons per annum, which has a capital expenditure of 95 crores of Indian rupees. And once this is done, then with a time lag of 2-3 months after it is commissioned, we will go in for a replica of this project to double the capacity, and the capex would be another 50 crores of rupees. Then Ahmedabad JV was announced, and here we would be spending some 30 crores from the other side. Then we are working on many projects, the tire recycling and solar panel recycling, e-waste recycling and other things. The studies are at advanced stage, and if they materialize, then maybe over the next 2-3 years, subject to we concluding and putting up these projects, another capital expenditure of 100 crores could be estimated. So that's a summary of the capex, estimated capex.
Hello? Does that answer all your questions?
Yeah. Yeah, so just last thing on margins. Did you guide over next 12-18 months how the margin profile will look given the new projects coming up?
We have already discussed this earlier also about the margins, and I've already explained in the previous questions about the guidance and the future. So I think we have.
Okay, sir. I'll go through the transcript. Yeah. I got dropped off, sir. Thank you. All the best, sir. Bye-bye.
Thank you.
Thank you. We take the next question from the line of Dipti Rajulapati from Axis AMC. Please go ahead.
Hi, sir. Thank you for the opportunity. Just wanted to check you out.
Dipti, I do apologize to interrupt you. Your audio is not coming through clearly.
Oh, am I audible now?
Yes, please go ahead.
Thank you. I just wanted to check on the timelines of this JV. When will the plant commission, and the capex includes land costs? Yeah.
Mike, would I take this question?
So Mayank's line has been disconnected. Give me
okay, I will
join you.
I will reply. So your question was time frame. So timeline is we have just finalized the place, and now and maybe after licenses and the machine installation, 6 months to 9 months we'll start the production there, and the plant will get stabilized maximum 9 to 12 months, and 6 to 9 months of production will come. And what was the second part of the question?
The land cost, is it included in the capex that you have mentioned?
No, we do not. We are asset light here, and we do not bought any land, plant, machine, everything. What we are buying right now on the rental models. So the land, shed, the buildings, we are taking on rent, and we are not going to be owning assets, so we are asset light.
Okay. What's the thought process behind going in a JV route rather than putting up a plant on your own?
So it's a good question. You must understand in the business of recycling, sourcing is very, very important. As much as you source, you can recycle, you can sell. And there is nothing called order book, sales book order here, always a purchase order book. How much you can source, you can recycle, and you can sell. There is no problem. And you can even manufacture also by increasing capacity. To secure and to avoid the competition, two big giants in the recycling space in the world, in the copper, is CNY and Jain. So we joined together, and since we have global sourcing, and CNY is only US-based sourcing, So we come to competition, and this items also new, this electric motor scrap, and they have more strength in this. So to strategic partnership reason, we have joined together.
Okay. Thank you so much.
Thank you. We take the next question from the line of Sukrit D. Patil from Eyesight Fintrade Private Limited. Please go ahead.
Good afternoon to the Jain team. I have two questions. I will just combine them into one and ask. As you have already laid out the growth plan for Jain recycling, but when it comes to actual scaling this model, especially with supply chain gaps, compliance hurdles, and technological integration, how would you be navigating through these challenges, and what kind of internal strength are you building? And my second question is with regards to the input cost swinging and compliance costs that are rising, how would you be planning to keep the margins steady? What are the plans that Jain Group is going to put into action that will keep the profitability in line also? Yes, thank you.
The first question was a little confused question. What exactly you want to say about the compliance and cost? I don't understand your question. What was the question, the first question?
My question was, as you have laid out the plans, but to, I believe, to put the plans in action, you will have to deal with a lot of supply chain gaps or compliance hurdles. So how would you be navigating through these?
What do you mean by compliance hurdles? Supply side, I already explained many times that we have deep sourcing capabilities. Just now we have joined hand with CNY, one of the global giant in recycling in the US. And there are many proposals such that we can join, and we have deep 120 country plus sourcing. So supply chain is not at all challenge because that is why we are growing. We are growing 40% CAGR year on year, and this year also we have shown more than our projected. So there is no supply chain challenges. Of course, it's one of the key point in manufacturing these commodities, but supply chain is challenge. That's what we are competing and we are growing. What is the compliance issue here you're talking about that? Which compliance issue can you explain to me?
Sir, the participant has left the question queue. We will move on to the next question, which is from the line of Parikshit Kabra from PKD Investment Office. Please go ahead.
Hi, thank you for the opportunity and congratulations on your results as well as your listing. I want to understand, you've given your CapEx plans for the next year or so across most of your segments, but you didn't mention anything about lead and aluminium. And I want to focus more on lead because basis whatever numbers I could pull out from the DRHP, it seems that you're already at about 80% capacity utilization there, or that's what I could figure out. So could you just give us some guidance on how you're seeing that segment going to evolve over the next year or 18 months?
You're asking about the lead growth?
Yes, lead. I'm asking about lead because I think your capacity utilization in lead is upwards of 80%, and you didn't mention any capex on lead.
So what we do generally that every year we keep 20% capacity extra. We do not as this business is on sourcing side more. So we keep our capacity extra, and when this capacity gets full, we again additionally build this capacity. Now what happened last year, we built 80% and 20% extra. We kept what we made ready. Now this year, that 20% has been fulfilled. That is why the lead sale has gone up on this current first half. If you see, the lead sale has gone up by I think almost 30-40%, which Hemant can clarify more. But the lead sale has gone up hugely. And again, now we are running 100% capacity full of lead. We are going to additionally build 20% capacity. So basically, our base infrastructure, which includes the furnace and the laboratories and the battery breaking machines, all are having high capacities. We will put more grinding furnace to additionally build and increase the production. So that is where the small investment in the capacities will build the large production. And that is so that way every year our average growth of 30-40% will be having in the lead also.
Got it, sir. So just one quick question on this. One of your peers mentions a strategic advantage being a geographically diverse footprint allows him to source and supply to his customers with a cheaper logistics cost. While you have mentioned about how your location and concentration near the ports is a strategic advantage for more from an import and export perspective. Are you also thinking about diversifying your geographical footprint so that your sourcing is closer to your factories and your suppliers, etc., etc.?
So it depends on the business model and where you are selling your product and where you are importing your raw material. Now, in our business, our model is very simple that we want to centralize one location to reduce the cost of production instead of managing so many units in different places. It's a challenge for us. And the bandwidth requires a big way. So we have centralized one place and larger capacities, and that way we reduce the cost. And we also advantage of Southeast Asia because we export our 70 to I think 80-90% lead for export market, and we are not selling much in India, and we are selling more on abroad in Korea, Japan, and Singapore and Malaysia. So we don't have more customers local than export. So that way we are different from others, and we don't need a geographical location to run the plant. So one centralized location help us to reduce the cost and the bandwidth, and export market is as a freight advantage from Chennai to Southeast Asia is huge and is almost zero freight. That will help us to export more and more.
Got it, sir. Thank you so much for your time and the opportunity.
Thank you. The next question comes from the line of Ankit Babel from Shubhkam Ventures. Please go ahead.
Good afternoon, sir. Sorry, I missed the growth part, the growth guidance which you gave. So, considering your H1 performance and the upcoming capacities, what kind of revenue growth you see in FY26 and 27 for the company as a whole? And also, what are your sustainable operating margins for 2 years? For the company as a whole.
So, Mr. Mahant, are you there? Can you reply this? You want to take this?
Growth predictions, Hemant has got the growth prediction figures.
We're not able to hear you, Mahant. What is that?
The question was about the growth perspective in 27?
Yeah, revenue growth for the company as a whole.
Yeah, so I rather invite him because he has got the...
Okay. Mahant is actually traveling abroad, so his lines are not clear. Hemant, you would like to take this question?
Yeah, sure. So with respect to the revenue growth, so presently you can see our H1 performance as compared to the last year, we have shown a growth of around 27% in the revenue.
Yes.
With the present capacity utilization and the capex plan what we have, we estimate that this growth of around 20-25%, which we have already performed in the last 4 to 5 years, this growth will still continue on the present portfolio of the products. And can you come up with a second question, Ankit?
Sustainable operating margins for the company as a whole.
Yes. So with respect to the operating margin, already Kamlesh sir has explained in his opening remarks, and with respect to the margins with the segment-wise, I think lead, we are almost at par and par with other peers. And with respect to the copper, and which has grown from around 33,000 per ton to presently at around 50,000, this will be sustainable because of our capacity of deep sourcing and the duty structure which got scrapped within this budget for the current financial year. So with this, with all these factors, we estimate that this EBITDA margins and in each segment will get sustained. And this has been proven in the past records of the company for last 3 to 4 years.
I would like to add, as Hemant said, that this budget, last year budget in February, the duty structure, lead and copper becomes zero, and there's a main commodity for us. When it becomes zero, we are getting the export advantage in a much better way, and that also increasing our EBITDA margin in a bigger way. And that impact you must have noticed in the first half result of the year, where our EBITDA and PAT margin has gone up because of the duties also become zero.
Okay, and one small question, what would be a finance cost in FY26 and FY27, considering the revenue growth and the working capital requirement, and also the fact that you have repaid part of your debt through IPO proceeds? So finance cost basically how much?
Ankit, what we do is that mainly we import on non-fund LC limits. Our rotation of the money happen on the LC limits when we import the material and we open SBLC to suppliers, and that is around 5% to 6% total cost, which includes so forth plus some basis point. And that is our finance cost for the importing the raw material working capital cycle, because most of our imports are happening through this. And as far as the overall finance cost will go proportionately because of the working capital requirement, and as when the production goes up also, that's on the percentage of the turnover, the finance cost may go down, and the IPO money of 500 crores will be also utilized to repay the bank debt, which will reduce the finance cost in a much significant way. And I think next year we'll see less number in proportion to the sales of the company.
Any numbers, sir, against 85 crores? What last year it was 85 crores approx. So what number you are looking at for this year?
Hemant, you will take this? Hemant, are you there?
Yes, I'm there.
Can you try this?
Yeah, Ankit, can you just give 85 crores means you mean to say the finance cost?
Finance cost last year was approximately 84.7 crores. So this year you're looking at what, and next year also, if you can guide.
With this primary infusion of 500 crores, where we have used around 375 crores to repay the debt. So basically we will save around 24 crores on 24 to 25 crores on the finance cost because of the repayment. But as you see, the volume growth has happened to around 27% on year-on-year basis. So that will additionally being funded from the internal accruals. So we estimate this finance cost will come down to the extent of around 20 to 22 crores on an annual basis.
On an annualized basis, okay.
Yes.
Okay, so at best it will remain at 85 crores. It will not increase. Okay. Thank you so much, sir.
Thank you. We take the next question from the line of Pallavi from Samiksha Capital. Please go ahead.
Yes, sir. Thank you for taking my question. This was regarding this the inventory. You mentioned about the imports seeing more investigation, but if I look at the raw material sourced from domestic, it's gone up this year to 39% versus last year average of 25%. So just wanted to understand this point better.
You mean to say the raw material cost of production gone up, you're asking?
No, not cost of production. The raw material source domestically is up. It's gone up to 39%. As per RHP, it was 25%, 23%. So we've sourced more domestically, yet our working capital, our inventory days has gone up. So I'm not able to, reconcile those two things.
Okay. So the raw material sourcing of domestic has gone up for sure because we are focusing more and more now Indian market. Compared to previous, because Indian recycling market is also getting organized now, and there are organized companies that are coming to for selling because with all the compliance of GSTs and other issues. So, and we are also buying semi-crude material also to make it into pure refined and make it into a proper branded product. So there are many local factors which are supporting the domestic sourcing of the raw materials. Coming back to the point of the alignment of the cost of the fund, you are saying the cost of interest has gone up. So see what happens is that...
No, I'm saying about inventory days.
Inventory days, okay.
If you are sourcing domestically, it should actually help to bring down the inventory days.
You're right, but what happened is that subsequently our direct sourcing also gone up very high way. So when we source domestically, the cycle is done faster, no doubt in that. But we also increase our direct sourcing. In the direct sourcing, we used to buy earlier CIF, Chennai port, and we used to make payment on the arrival. But when you source directly to scrap from the scrap yards and those scrap scrap recycling companies, then we have to make the payment and take the material from the US and other places where we make advance payment and take the material to have better margin and better security of raw materials. So those also gone up. So overall, because of direct sourcing gone up, the cycle of the payment rotation also got more. If you want a segment-wise breakup also, we can give later to you that why it has been going on. But the main reason is direct sourcing gone up. That is why our cycle is going up.
So what is the share of direct sourcing in the total raw material?
I will give you segment-wise. I don't have data right now with you. I'll give you the segment-wise. You drop me an email. I'll reply back to you with the segment-wise.
Right. And sir, my second question was with regard to the related party transactions we've seen at the RHP. So some factory is leased from the promoter. So the new facility also coming up will be on lease from promoter, or are we going to see a reduction in the related party transactions?
Basically, these are the earlier in the what we are saying that I think the merger of company has drastically reduced the related party transaction. They still will have some one plant or other plant. So recyclings are getting interconnected. Now what happened is that, but right now it will come down because of the two major company copper and lead got merged. So it will come down for sure, but we'll still have some transition because of Jain green technology, which is expanding into copper and aluminum recycling company, and the company expand to copper also. So there will be supply of the raw material from one plant to other plant. And let's example, when we recycle aluminum cables, we also get copper content in that. And that copper content we have supplied to main company, which is called JRR. So there will be always a related party transaction, and there will be supplies side and the to exchange raw material, because different companies got different strength and has to be compensated with each other's raw material requirement.
Right. My last
one more thing, ma'am, I would like to add here is that the inter-party transactions, what you are referring to. So both the Jain green technology is a 100% subsidiary of JRR. And as already Kamlesh sir has explained, when we import the scrap, we get the scrap of aluminum also along with sometime in the cables and other things. So which we sell to the 100% subsidiary at an arm's length prices. And all the prices are being driven by LME. So hopefully that will not get much impacted in any of the profitability of any of the company, because both the companies the profitability gets merged and the transactions get nullified.
Right, sir. My last question was this on the financials. In the other financial liabilities, they have increased from 50 crores to 800 crores. I just wanted to understand what it is.
Sorry, the other?
In the balance sheet, the other financial liabilities.
Okay.
That is increased from 50 crores to 800 crores. So what item is this?
So that what happened, we have got this IPO money on the last day of this first half of the financial year. Okay, so we need to account for the liability payable to the selling shareholder, because all the money which has been got for 1,250 crores into the company's account, and which was paid to the selling shareholder on the 1st of October. So that 818 crores, what you are seeing as another financial liability, is consists of 750 crores payable to the selling shareholders.
Right. Okay. And sir, lastly, in China, what is the size of these recyclers there in terms of competitiveness versus the Chinese manufacturers? If you could share some light on that. And is there any listed company in China in the same business, similar?
China has got certain rules and regulations. So most of the Chinese are doing in Thailand and Malaysia recycling. And first of all, as I told you, India has got some unique USPs in recycling, which China and other countries not having. That is why the CNY also came to India to join us, because of the India's three USPs. And first is the cheap labor supply and the mass labor supply. So the cheap labor supply and the mass supply will not be available in many countries of the world. That's why India is ruling in the recycling. Number two is the plastic ecosystem. What India has having this plastic ecosystem to make cheaper plastic products from this plastic waste, which is generating from cables and batteries, is not available to other countries, because, for example, ले लो आपकी हवाई चप्पल कौन पहनता है? तो इंडिया में गरीब लोग पहनते हैं, गाँव में पहनते हैं. इसी तरह आप देखोगे प्लास्टिक के जो इंडिया में जो चीप जो योगा मैट है, कार मैट में सब यूज होते हैं और ग्लोबली पहनते नहीं है, फैक्ट्री के जूते बनते हैं, टिश्यूज बन जाते हैं, ये सब बाहर अवेलेबल नहीं है. सो दिस इज द रीजन व्हाई India got USP. And the third USP India has got is the government clear guidelines and rules and regulations and the license quota system. Where the government is promoting recycling, government wants to making of recycling, like they are promoting recycling theme park, they are promoting the incentivize. You must have read the 2 days back where the critical mineral recycling policy also came for the various non-ferrous metal. So government is promoting recycling in a big way. So these are the USPs and export advantages what we have from India to other countries is not available in so many countries. So that is why India is big in recycling and India is growing in recycling. So comparatively, we don't have any fierce competition from these countries.
Thank you, sir.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question and we conclude the question and answer session. I now hand the conference over to Mr. Kamlesh Jain for his closing comments.
So that was our question?
Yes, sir.
Okay. So thank you for the opportunity given to us, and we appreciate your participation in our earnings calls today. And we trust that we have addressed all your queries. Should you have any further question, please feel free to reach out to Strategic Growth Advisors, our investor relation advisors. And thank you once again, and wishing you all a very happy Diwali and a prosperous New Year.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.